Hello, everybody. Uh, Lauren, Dawn, and Jonathan today. Welcome to our first Monday market recap and also outlook. We thought to mix things up, it might be kind of fun to let you know what we're thinking about going into our investment committees, which we have on Tuesdays. So we'll talk briefly about what's been going on in the markets over the past week, but also importantly, what we are thinking about and looking at this coming week. So hopefully this is informative to everyone. As always, send us any and all feedback so we can keep providing interesting and helpful content for you all. So today, Dawn and Jonathan, what things are you looking at? Questions do you have? What's top of your mind for our investment committee debates tomorrow?
Well, I'll start. So so JT doesn't say anything that I'm about to say because I don't know what he's going to say. But I would say that I'm glad that we're through last week. Last week was a big, important week for us earnings-wise. I would say felt a little bit like a prize fight. We didn't come out of it without any scratches, but we won some and we lost some, and we always live to fight another day. But I think the interesting thing to talk about, and I'm going to do a little quick screen share. I don't think you guys have seen this, but can you see my screen?
Yep.
Okay, so I think this is going to be an interesting debate to start to have in our investment committee, and that is a 1 month chart of Zoom communications, which is the poster child for our stay-at-home movement. And that happens to be on the blue line, and the green line is the stock of Berkshire Hathaway, which is still down, I think, close to 15% or so for the year. And I think what is interesting about this debate is we are seeing it, or we are seeing early signs of a shift from the momentum growthy trade that has become so in vogue to the more, basic economy type stocks, what we're calling value stocks. And so whether or not we think that this has the ability to be a durable trend, and what, if anything, we ought to do about it if we do think it's a durable trend. And I have my own thoughts, which I will withhold until I hear what everybody else is thinking. But what will be true is, at some point in time, as we've been sort of hinting at and talking about, that will be a worthwhile evaluation and shift. And the strength of the long view strategy is its unconstrained charter or mandate. So we have the ability to take advantage of it if there are, because at some point post-COVID, there will be a boom in certain segments of the economy that have been shut. And so the same way that I think a lot of the growth stocks got rewarded for the boom of when everything was shut, that will also be rewarded. So anyway, that's on my mind, and I'll look forward to engaging in a spirited debate on that subject tomorrow. So Jonathan, I'll throw it over to you if you have anything to add.
Yeah, just to remind everybody, for those of you who don't know, Jonathan runs our mirrored or aggressive growth strategies. So while the long view strategy, which a lot of you're probably in, has kind of a balance with value, large cap, also growth. But the aggressive growth strategy is primarily growth and smaller cap focused. So Jonathan, kind of specific to what you look at, what are you thinking about this week?
Yeah, so thanks, Lauren. Specifically on MAGs, like you said, we're a small cap growth focus, so we don't hold any of the FANG names or any blue chip companies. Instead, we're trying to fish for companies in the 300 million to 5 billion market cap range, where there's not a lot of coverage and we think can provide exponential upside. As for this week, well, first of all, over the weekend, President Trump passed his executive orders, which extend some of the eviction memorandums and extend some unemployment benefits. So that's great. This week, I think what Don said is right, is looking at that reflation trade, I call it. We saw it on Thursday and Friday, where the large caps that ran up are coming back down. The high flying SaaS company valuations are sort of getting stuck, and you're seeing, like today, we're seeing airlines, we're seeing cruises, we're seeing the industrial sector rally really strong. So is that reflation trade really sustainable? One of the other things that I'm really looking at this week closely is the risk premium, as I say, on equities right now. So if we look at where valuations on the S&P 500 or on the NASDAQ sit in relation to the yield that you can get on treasuries, like 10-year, 20-year, 30 years, that spread is about as tight as it's ever been over the past 7 years. It was this tight in January of 2018. It was this tight in October of 2018. It was this tight in February, and it's sort of reaching a wall that it has tested, and it has never broken like 15 times over the past 7 years already. So we're there again. That wall is about 5.5% against the 30-year Treasury, and today we're about 5.6. And as we said, with the reflation trade, we would expect to see longer duration treasuries sell off more and their yields would come up, which is what we're seeing. The 30-year a couple days ago was almost below 1.2. Today it's 1.4 and it's going higher. So if those long duration yields start coming back, there's sort of an argument, right? So some market analysts believe that higher yields will support higher valuations. Because higher yields represent that the economy will recover better than most expect. So that recovery will play into equities and allow for higher valuations. I actually sit on the other side of that trade, where I think that higher yields, in the long term, of course, it has to do with economic growth. But in the short term, it has a lot to do with what we've been talking about with monetary policy and fiscal policy and fiat currency. So in the short term, when we're seeing these long end duration rates go up, it's not really a function of the economy getting better. If anything, the economy is starting to get incrementally worse. It's more of that reflation trade where inflation is coming in because of the monetary stimulus getting pumped in. So when those yields come up, it actually is not supportive for equity valuations, which will have to come down.
And I would add one thing to that, Jonathan, which is the worst case scenario for a decade would be a decade of stagflation, where we have, sort of monetary inflation combined with slow or negligible growth, because it's an erosion of wealth, across a spectrum. And so I will throw in one other chart specifically to somebody who knows who they are over the weekend, who noticed that we had added gold to, this is that fiat currency, alternative. And they said, well, isn't it too high to add? And I said, well, that's interesting, because it's certainly higher than it was a relatively short, $6 trillion of money printing ago. It's higher than it was then. But if you look at this last top in here, this is 2011, 2012, post-financial crisis. And obviously the commodity, segment, we're sort of pointing to a recovery in the economy and post-financial crisis. And obviously that lasted a long time. So my point is, if this is 177, which is August of 2011, which is what that is, and this is 190, anything that's gone from 177 to 190 in 9 years is hardly, unbuyable from a price perspective. And obviously when we're buying gold, we're really just caring about the price, since it doesn't pay a dividend or anything like that. So I will argue, as I think you guys agree, that we are in the early stages of what could be a challenging period for the dollar, and it's helping all kinds of other assets, which we will, as you've seen, we added Freeport-McMoRan, which is sort of a gold copper proxy, And so different things like that will come in, and we will play it a variety of different ways. So.
Great. So sounds like you guys are both looking at similar things. We're happy that we've maintained this exposure to some more value and some more industrial positions, or added them in our strategies to balance out the growth that we've gotten from healthcare and tech companies. So,
like they say, up on an escalator and down in an elevator, because when the growthy names start falling, they don't fall in cents, they fall in dollars, and so it's hard to be too exposed to them at the wrong times. So,
right,
very true.
Great. I will add one note to something that I've been looking at, and we'll bring up tomorrow just very quickly. We were updating our Tri-Valley research and noticed that Tri-Valley startups have raised over 300 million in equity this year, 2020, and that the Mirador Tri-Valley Index is up about 9% for the year. So it's hopeful for us that our thesis continues to be true for the time being, at least, that Tri-Valley companies and sectors here are proving to be fairly resilient. So we're happy for our clients that have that in their portfolios.
And I will add, if it's something that sounds interesting and you don't know if you have it, which is probably possible with some of you, or you don't have it and you would like to talk about it, whether it's appropriate for you, I refer to, everybody knows, as our strategies as cars on a car lot, and the Tri-Valley Index is the sort of souped up sports car. So it's something that it's great when it's great, and it's certainly great right now, but I wouldn't put all of anybody's money into it, because there are certain times when it's not fun to own. So, but we've been through a few of those now, so we know how it recovers, and certainly now is one of those periods. So reach out if you have questions.
All right. Thank you, everyone.
All right. Thanks, everybody.
Have a great week. We'll be back next Monday.
Talk to you soon.